So as we get to the final week of the summer quiet season and market participants get back to their desks after the bank holiday weekend, it's worth having a quick review of where we are. Markets have actually been very strong since February and throughout the summer. It's been led higher by better economic numbers, and here we've got the Global Economic Surprise Index. You can see that the MSCI World Index has been following that. That's also been happening in the UK, and particularly since Brexit, we've seen a real sharp increase in the positive surprises coming out of the economic numbers. People expected it to be worse. That, in part, is a response to the weaker currency that we've seen. So the Bank of England has got ahead of the curve. They've weakened sterling here against the dollar, and they've been able to do that because bond yields haven't risen. Bond yields in the UK and government gilts have remained in high demand, and therefore you haven't seen the negative effect of rising yields and increasing costs offsetting the positive benefits of a weaker currency and the typically inflationary effect of having a weaker currency. You've also seen, because of the very low yields, money starting to be forced into riskier assets in search of returns. So finally, the central bank's policy of lowering yields is starting to do what they expect by forcing money into riskier assets. Despite stronger markets, and if we go to this chart, we've got inflation expectations, which is measured by this five-year break-even curve. They've remained stable or anchored throughout this period of stronger markets. So if we go to February here, that's when the market rally began, and as you can see here, they're basically where they were. This is because they continue to track the Chinese devaluation. And again, if we go back to the impact of the very weak markets in February and what came out of that with the coordinated monetary response, we have seen Chinese devaluation continue to exert a deflationary impact on the global economy. And therefore, despite improving economic data, you continue to see yields at very low levels, inflation expectations at very low levels, because central banks are having to take account of what's going on in the wider economy. We are at a juncture now, because of this effect, where we've seen quite a big decoupling of markets against bond yields. And here you've got a chart showing the 10-year US gilt yield against the S&P 500. And again, you can see since February, there's been a very big decoupling. So where we are now in terms of what move we see next is the likelihood of you get some sort of mean reversion. And that mean reversion will be stimulated by central bank's interpretation of what the global picture is. And that's why this week and the previous week, where we've seen a lot of the Fed chairman talk about raising rates at some stage, and we're seeing Janet Yellen talking at Jackson Hole this afternoon, is so important for markets, because we need to understand how they feel that particularly the US economy fits into the wider global macroeconomic situation, and whether this deflationary impulse from the Chinese devaluation is trumping the inflationary impulse that's coming from the domestic economy, that's feeding from full employment figures and quite a robust domestic picture. Next week, results are thin on the ground. Here we've got the list. None of the UK or global stocks on our buy list are reporting next week. But there'll be plenty to think about, as typically the first week after the summer holidays, the market action is a good precursor for what's going to happen in the second half. Thanks very much.